Kí ló ṣe ẹ́? What's been up that? Is it a good thing?
Way the exam is being structured is structured into objective and theory. Your session A is number 1 to number 20, which is your objective, while your session B is your theory, where you compute and you write. So today's class will just be an introductory to what we expect to do. Then from there we kick off. Okay. So today we'll be trying to lay a foundation on what we'll be building on later in the class. So we start from the introduction of financial statement. Now, before we can talk about financial transaction or related activities, there's need for us to talk about what led, what the reason why we have transaction in the first place. Now, the reason why we have transaction in the first place as a result of business in which we engage ourselves in, and that's what we call business. So our trading, our profit, well, the reason why we enter, the reason why we carry out activities to earn a profit. So that's what we call, in summary, that's what we call business. So our business is a set, business can actually be defined as a set of interrelated activities carried out with a view to make profit. So when you are doing any activities and the major purpose is for you to make profit, that can be classified as a business. Now, business have different forms, and the forms can be classified into three. We have the sole proprietorship, we have the partnership, and we have the company. Let's talk few about them before we move on to the next topic. One last thing we want to talk about. The first form that we have here is sole proprietorship. What is sole proprietorship? Sole proprietorship simply means one-man business, in which one we have the owner, which is a single person, and also we have is one that carry out the activities that relate to all transaction, all the that have to do with the business. Every transaction, every activities, every decision making that have to do with the business is falls on his shoulder. So that's what we call sole proprietorship. So one proprietorship. So then it have its own, but before you can actually do commence a business, it's expected to have a permit or a license before you can commence a business. So in the environment in which you want to set up on or set up in, you have to obtain a license from the local government or from the state government or either from the federal government. It can or depend on the area that you want to operate in. Now, in that knowledge, we can now move on to the is what are the advantages that flows on sole proprietorship. Number one advantage is that there's actually great efficiency. Great efficiency in the sense that there's no need for him to actually require for wait for anybody before he acts. So he can easily act. And once it acts, because the site is small, he does not need too long, it does not need a lot of uh, production factor to work with. So with a short production factor, it can still it can still operate at a reasonable level. Now, another disadvantage is that there's a what we call pride of ownership. Pride of ownership that is happy that he have a business, that he runs a business, he pays salary and earns a living. That's another word, reasonable advantage. Another advantage is that the profit is the owner of his profit. All profit either is 10 naira or is 1 million naira, is the owner of it. It does not share the profit among with anybody. Now, after that being said, let's look at some of the disadvantages. One of the disadvantages is that his liability is unlimited, does not have a limited liability. So once there's any issue with his liquidity or his solvency, and he needs to pay the third party, it needs to what? It can go as far as selling his belonging to fulfill his obligation. Then also, lack of speciality is another area that affects the growth of sole proprietorship. A one-man business means that the expertise in his own line can only be applied, while in other lines, which the expertise might be needed for the business, will not be available. So when there's lack of expertise, it in one way or the other affect the efficiency or the delivery of such business. They will also have limited of capital, finance resources. There are some banks that will not borrow sole proprietorship money because of the exposure to the bank. So the where they substitute for their capital is mostly from their savings, family and friend. Because what? Because of the risk in which they operate on. So we have limited lifespan. The limited lifespan is because it's actually as a result, the lifespan of the business is tied to the lifespan of the owner, because the death of the business owner can actually lead to the end of the business. The probability what it can lead to the end of your is early high, because it's run by one man, and once the person is not available again, then there's no resources or there's no plan for another person to take over. Then also we have absence of employee development, because there was is there absence of the development of what called employee development, because the supervisorship believe in themselves, and at the same time they try as much as possible to render a service. They are trying to render a service. So when employee comes on board that they need some training, they need some development, they actually don't see need for it because of their small limited operation and their small scope of the of the activities they engage in. So the second form of business that we have is what we call partnership. Partnership is actually a legal business organization owned by at least two people, two persons, and at most 20 people. So when two people or 20 people comes together to form a resource, to form a what? They come together because they have the same interest or they have the same idea. And the purpose why they are coming together is to form a business that will generate profit for them is regards to as partnership. Is regards to as partnership. So partnership is what? It's form of minimum of two persons and maximum of 20 people to come together, bringing their resources together to develop or to start a business in order for them to earn profit. So usually, when you talk about partnership, there's always a guide. There's something guiding the partnership, and that's what we call deal of partnership. Deal of partnership is a document that lists out every guide on how partnership are being run, and also it lists out what the do and don't in the partnership. So it's actually very important. Deal of partnership is actually very important because it states out number one how they share the formula, how they share the profit. Number two, how they share the loss. Number three, they talk about the if there's conflicts. They talk about if they want to add a new partnership. They also talk about if a partnership want to leave, what are the steps? How do you address it? So if there's conflict between the two partnership, how do you address it? So deal of partnership actually what is very important because it helps to remove any query that may arise as a result when running the organization or the business. So part of the advantage is that it have a larger capital partnership because individuals that have their own connection will bring it on board. And looking at supervisorship that is just one man resources, but now looking at 20 people bringing their resources more, it means what it will multiply the supervisorship times 20. There also is what they call there's actually a larger pool of knowledge and decision making. The decision made under the partner is always richer than the decision made under the supervisorship because every one of them will bring the expert on board and they will try as much as possible to provide what we call the trial model to provide a decision or to provide or bring new area into play so that people can see, okay, this is the area that we have not talked about. We need to look into this area as well in order for us to improve. Then also, we also have that what the one last bit I want to talk about the advantage is the longer survivor. So they have the longer continuity, possibility of continuity compared to sole proprietorship because the death of a partnership might not lead to the end of the business. So the death of a partnership can actually it might not lead to the end of the business. So it have a longer continuity compared to sole proprietorship. Now there's always what disadvantages on this partnership. One of the disadvantages is that their liability is unlimited. It's unlimited as well, just as proprietorship. Now, if the business runs into liquidity issues, the partners will need to sell off their personal belongings to address that issue. Another one also is what there is slow decision making. Slow decision making is because they have to wait for all the partners to be available before decisions are made. Because if a partner make decision without others being available, it can actually backfire on such partner. So the decision making is always slow. And that one also is what we call the distrust and disagreement among partners. There can be a situation where there will be distrust or what we call what disagreement between these partner. And if that is the case, and if it's not arranged or if it's not addressed on time, it can actually affect the growth and the expansion of the business. Then lastly, the third form of business that we have is what we call the company. The company. A company is actually a legal person without physical existence, recognized by the law to do business for profit through its agent and servant who exist physically. Now that's what the company means. It means that what is actually seen as a legal being, a living being, in the point of the law. So they are actually they regard him as an existing being. So it means that the company can sue and be sued. So if I have a company right now, I see the company is separated from me. It's separated from me because I'm the owner of the company. Does not mean that if you sue my company, you are suing me. No, it's a separate entity on its own, a legal entity. So that's another concept that we have. Okay, so that's another concept that we have in our in FA. So is is seen like a being, like a living being. Now, a company may be actually a legal entity can be sued or be sued. It means that it can take someone to court and it can be also be taken to court. So the ownership of the business also is recognized through shares. You can be part or owners of the company by by subscribing to shares. That's where we have what we call the original shares and issue shares. It means that the total shares that are being issued out to the public to subscribe to. So when you subscribe to the shares, that amount that you subscribe to is what is used to recognize the total capital that flows into the organization called company. Now, after we have addressed the form of business, the type of form of business that we have, it's now very important for us to now talk about some key definition terms in financial accounting. Now, first one we want to define or want to talk about here is what we call the accounting and bookkeeping. And we want to try to differentiate the two so that we have a clearer and a better understanding. Now, accounting is actually a system meant for measuring business activities. It's a system that is used to measure the business activities, processing of information into reports and making a findings available to decision makers. So accounting basically summarize the business activities for a particular period of time. And when you summarize it, why are you summarizing it? So that the users can make use of it to decide, to make decisions on time. That's what accounting is talking about. So accounting can also be defined as a systematic way of recording transaction. That's accounting. A systematic way of recording transaction. Now, let's talk about the bookkeeping. Bookkeeping is the systematic recording and organizing of financial transaction in a company. That's good. Let me finish the definition of an accounting earlier. So accounting is a systematic way of recording transaction, and also it can be defined as a systematic way of recording, classifying, summarizing, and interpreting and communicating financial information to to the users of the financial statement. So that is what accounting. So accounting goes more further and deeper compared to just recording and organizing financial transaction alone. But bookkeeping right now, it says that it is thematic recording and organizing of financial transaction in a company. So all what they do in bookkeeping is they try as much as possible to keep records of the daily transaction that occur in the business. So it means that bookkeeping is a date-wise activities. Why accounting does not just stop at recording transaction alone, but they go ahead to classify them into their head, to summarize them, to interpret them, and communicate such to the users. So when the users take it over, they are not just seeing records, they are seeing information that is available for them to make their decision, to make their decision on. Now, because of our time, let's quickly talk about the difference between accounting and bookkeeping. Now, what is accounting? Accounting is often confused with bookkeeping, right? Because bookkeeping is a mechanism process that records the routine economic activities of a business. While accounting includes bookkeeping, but it goes further to analyze and interpret financial statements. These have been explained earlier. Now, let's talk about financial accounting, because we talk about accounting does not mean that we just have one aspect of accounting. We have different areas of accounting. We have management accounting, we have cost accounting, we have financial accounting, we have auditing, we have tax, we have those different areas of different branches of accounting. But because of our focus will be restricted to financial accounting. So let's talk about financial accounting. Financial accounting actually deals with the preparation of financial statement for the basis purpose of what? Providing information to various interested groups like creditor, bank, shareholder, financial institution, government, consumer, etc. So majorly, the financial accounting is actually a report. It's a report of the financial transaction that occur for a particular period of time, And it's a report of a company, of a single company, not different company in one financial statement. And why do we keep it that record? The report is an historical course. Hope you know, because we report what have occurred, what have happened. We don't report what will happen. So we report what have happened, and we present it in a systematic way that will be as useful for the users of the financial statement. So the end product of the financial accounting is financial statement. The end product of financial accounting is the financial statement. And the person that is responsible to prepare that is what we call the financial accountant. So the accountant is one that prepares the financial process, and the activities or the process is what we call financial accounting. So financial accounting is charged primarily what responsible of external reporting, and also is the duty to make sure that it works in line with the what it works with the line with the concept, the convention, the rules and regulation that be given according in line with the conceptual framework of the accounting. Now, let's talk about the objective of accounting. What are the objectives of accounting? The first one is what? To keep thematic record. The reason why we prepare or the reason why we have accounting or what accounting intend to achieve is number one, to keep what? Thematic record. To have a record that is a systematic way to present it and to be free of errors, to be what? To be accurate. And when you talk about schematic is using what? Using a scientific method of recording it. Not just we record it the way it occurs or we record it the way we feel. No, but we record it in what? Based on the system that have been adopted in the organization. So accounting is done to keep systematic record of financial transactions. The primary object of accounting is to help us collect financial data and to record it in a systematic to drive correct and useful result of financial statement. The second one also is to ascertain profitability. Now, every businessman wants to know if it's making profit or not. That's very, very important. So financial accounting actually tends to address that. So they try to bring the activities that you have carried out against your income, against your expenditure, and produce what we know as financial statement. So when they produce your financial performance so in your financial statement, you have what we call financial performance. And from there, you know if you are making profit or not. From there, you can appraise yourself if you're actually doing well, growing, or you are declining. So that's another objective that the accounting intends to achieve. Now, all that also that accounting intends to achieve is that is what we call to ascertain the financial position of the business. Now, what do you understand by ascertaining financial position of this business? A statement of financial position indicates the financial position of a company on a particular date. So it helps us to draw conclusion of the classes of assets that we have. It helps us to draw conclusion on the class of assets. Do we have the opening assets? Do we have non-current asset, or do we just have concurrent asset alone? Do we what type of asset that we have? What sum of the asset? So with the help of that, we help us to easily ascertain the soundness of any business entity. It helps us to know if the business are actually doing well or not, because the financial position can also be can also be the term as the value of the business. Because the best way to measure, one of the best way to measure the worth of a business is by looking at the worth of their assets against their liability. That will tell you the worth of the business. So Our accounting also help us to achieve, to know the standard of what of the financial, or the position of the financial of what of the business. Then the next one also is for decision making. It's actually very good for decision making as well. Now, if you want to make a decision, you need information. You need to have information before you make decisions, so that you go what it can guide you to know if you should go ahead with a decision or not. So financial statement help you to what to make that decision. For example, you're an investor and you want to invest your money or your resources into a business. You need information to know how the business has performed over the years, so that you know if there's tendency for you to get to what to get your money back, or it's going to be into loss. So financial statement helps and guide to produce that. Then another one also that I want to explain here, is that to fulfill compliance of law. Now, to fulfill compliance of law is under objective. What do you mean by fulfillment of compliance of the law? Now, it's required according to this what the law that every organization must prepare their financial statement and file it with the government. Why? Because the government wants to know what you have generated, the profit that you have gained for the year, so that they will know the total tax that is collectible from you. That's what the government wants to know. So business entities such as company, trust, and society are being run and governed according to different legislative acts. So they want to know that what is the taxation that is paid to you? Is it the indirect taxation or the direct taxation? Are you paying VAT, or you are paying withholding tax? Or also they just want to know what will be your applicable, or the amount that you are going to pay the government. Now, after we have established the difference between the accounting and bookkeeping, and also we are able to talk about the objective of accounting. Then let's talk about the accounting process. Accounting process is the step-by-step stages in preparation of financial statement. We're talking about the stages in what in preparation of the financial statement, and these stages is applicable to any type of financial statement. Any type of financial statement is applicable, and it's actually very good for you to know and remember. The first one we have is there is what collecting and analyzing accounting document. Collecting and analyzing accounting document. Before you can post any transaction, you need information. You need to collect and analyze the information. So collecting and analyzing accounting document helps us a lot. It helps a lot. So and it means that there must be an evidence of your transaction. If there's no evidence on transaction, it means that there's no transaction. So you have to have source document. Example of them are WebP, invoices, receipts, local purchase order, international purchase order, service order, so on and so forth. These are examples of documents that you use before that you must have before you can move into your next point. Now, the next one we have is what posting in journals. What do you understand by posting in journals? Posting in journal is basically is what is recording transaction on a daily basis. Is what is recording transaction on a daily basis. And what is journal? Journals are prime books of entry. It means that what when a transaction occur, the first point where you post them to is journal, and they are date wise. Then from there you post from journal down to your ledger, because ledger is a principal book of account. So from your journal, you post into your ledger. You cannot post directly into your ledger without posting your journal. If you do that, it's liable. You are what? It's possible for you to make error. It's actually possible for you to make error. Then after that, we have preparation of trial balance. Now, preparation of trial balance is from the result of what ledger balances. So a trial balance actually contain ledger balances. So you have to first of all post into ledger before you can prepare your trial balance. Then, what is trial balance? Trial balance is what? Is a statement that tests the accuracy of ledger balances. Then after that, we have what we call posting of adjustment entries. Now, when they're talking about posting of adjustment entries, this is talking about that there's a need for us to adjust our entries. There's a need for us to look at there's some transaction that we have not captured during the month, but we need to capture it at the end of the month, because it does not lead to movement of cash. So we repost them, and we reappraise the figure. Then after you have adjusted the entries, the adjustment will be done on the trial balance. Then as the result of that, you have what we call adjusted trial balance. Everything, we're going to explain everything in details. You're going to see everything in details. So after you have the adjusted trial balance, we now move to what we call preparation from trial balance. It means that we normally prepare our statement from where? From our trial balance. We normally prepare our preparation of financial statement from our trial balance. It means when there's no trial balance, we cannot prepare our financial statement. Then after that, we have post-closing trial balance. Post-closing trial balance is a balance that will serve as our opening balance for the next year, for the new financial year. Now let's talk about financial statement. Let's quickly talk about the financial statement. Financial statement is actually written records that convey the financial activities and condition of a business or entity. It's actually what we call is a record, a document that shows the totality of the financial transaction that occur for a particular period of time. Now, financial statement is related to a given period of time. It's not an open-ended period. It's actually restricted to a particular period of time, which is 12 months, apart from 16 months that is allowed for a first-time business. If you are just starting a business for the first time, you are allowed to pay your first financial statement for a period of 16 months. So 18 months, that's 10 plus 6, that's 18 months, a period of 18 months. So you are allowed to prepare for a period of 18 months. But apart from that, going forward, your financial statement will be within the 12 months. And that 12 months of the financial statement that we prepare, we have a name that we call it. We call it either financial year, accounting year, or reporting year. So anytime you hear the word financial year, you're talking about what? The month that you have accepted to capture your financial transaction. Now, the beauty of this is that you are not restricted to any particular month. You are not restricted to that your financial statement moving from January to December or from February to January. No, it means pick any month you want to, or it must be 12 months. So you can go ahead and pick July to June. You can go ahead and pick January to December. You can go ahead and pick March to February. But one thing is that it must be 12 months. And once it's 12 months, the name attached to it was financial year, accounting period, or reporting period. Now that about that, now let's talk about the regulatories. Now, we have to talk about financial statement. What are the components? What are the things that consist of financial statement? What are the things that if you pick up your financial statement that you're going to see? The first one there is what we know as what we call statement of financial performance. Statement of financial performance. That is the first one that you see there. Now, the second one also that you see there is that what? The second one that you're going to see there is what we call statement of financial position. Statement of financial position. The third one that we have there is statement of changes in our cash flow statement. The third one we have there is what is cash flow statement. The fourth one we have there is statement of changes in equity. Statement of changes in equity. While the fifth one we have what note to the account. Note to the account. And we also have other reports such as what accounting policy. From there also we have directors report, we have auditors report, we have environmental report. So that is order. But the first five I've mentioned, they are the one that is required according to the law and according to IAS 1, according to the law and according to IAS 1. Now, there is the guide, there's something that is the preparation of financial statement. And one is the guide is what is the regulation of financial reporting. So let's talk about regulation of financial reporting. What regulates financial reporting? What I think that regulates financial reporting? Number one is what we call GAAP. That's general accepted accounting principle. General accepted accounting principles. That's GAAP. Now, one thing about GAAP, a code of accounting is to ensure information provided to the decision maker is useful. What we want to make sure is that what we are giving any users of the any user of the financial statement, they are useful, they are relevant, they are available, they are free from error, and it can be used for decision making. So I want to talk about GAAP, which is general accepted accounting principles. This is talking about the total rules, the total regulations, principles, concepts, laws that have been accepted that is used to prepare and present financial statement. So GAP is talking about what? It's talking about the total, the total rules, principles, conventions, law, concepts that have been accepted, generally accepted for the preparation and presentation of financial statements. So the major reason why GAP try as much as possible to provide what we call general purpose financial statement that anybody can pick it up and use it, and also to make sure that there's what we call that the financial statement is reliable, is relevant, and they can compare it on the they can compare it to the previous year or to another company of similar or the same function. Okay, now what are the sources of GAP? What forms GAP? What forms GAP? Number one thing that forms GAP is what? The country law and the accounting standard. The country law and the accounting standard. That is two things that form GAP. The country law. Now, what is mean about country law? Country law is referring to the states where you are working, where your business is established. The law that governs the environment will affect the way you prepare your financial statements. Accounting standard. Accounting standard is the pronouncement of a professional accounting bodies that guide us in preparation of what financial statement. So it's the pronouncement that is issued out by professional accounting bodies. Example of country law is what we call the CS or the CAMA. So it's about what how you should prepare the financial statement, the date and period and the duration for you to file the financial statement in the particular issues to address when it comes to some areas in your financial statement. So we have that. Then we have accounting standard. Example of accounting standard is what your IAS and IFRS. International IFRS. That's International Financial Reporting Standard or International Accounting Standard. So IAS and IFRS. These are the accounting standard that is issued by the accounting professional board, which is what? International Accounting Standard Board, ASB. So International Accounting Standard Board. These are the people that issue out the accounting standard. So now, because of that, GAP varies from country to country. You know why GAP varies from country to country? Because each country have their different rules that govern or regulate or guide them on how to prepare their financial statement. So that's why sometimes you hear what called US GAAP, you call Canada GAAP, you have Nigeria GAAP. That was the reason is because the country law varies from one point to another. It varies from one point to another. Now, let's really talk about the basis of accounting. The basis of accounting. Now, what do you understand as basis of accounting? There are three bases used to recognize and measure transactions. There are three bases used to recognize and measure transactions. What are the three bases? Under FR, we have three bases, and I'm going to explain it. So we have what we call the accrual basis, we have cash basis, we have break-up basis. The accrual basis and cash basis are being used when the company is on going concern. Is one that is used when the company is on going concern. While the other one, which is what break-up basis, is used when the company going concern is in question. It means that that in the next year, that company may not be in existence again. Now, what do you understand by accrual basis? What do you understand by accrual basis? Now, accrual basis simply means the recording of or recognizing of transactions, financial transactions, or the financial statement. So you recognize the revenue when it is earned, and you got expenditure when it is incurred. It means that when you don't wait for cash flow, you don't wait for cash flow before you go ahead and recognize revenue under what? Under the recognize revenue under accrual basis, and you don't wait until you make payment for expenditure before you recognize such under under the accrual basis. Simply means is that it's possible for me to have actually want to render a service for an organization, and they are yet to pay me. Now the service I've rendered, it means that that company will pay me for my service. But if they have not paid me for my service, I've earned that revenue, even though I've not received it. So definitely I can go ahead and record it as revenue in my financial statement. Also, for example, so expenditure. Let's say that I have a building I'm using to run my organization or my business, and that building I've not paid the rent for it, but probably my last rent expired last year, and for this year I've used 3 months in this year, but I've not paid for my rent. The amount of rent I've not paid for, I'm still going to pay for it in the future. It means that I've incurred that rent. So for that, if we incur the rent, then it means that what? It means that I will have to record it as if I've paid it. So I will record it in my financial performance that this rent, I've actually incurred it, but I want to put it on that liability that I've not paid for it. Now, cash basis. Cash basis is actually a technique that is used to record financial transaction in financial statement whenever revenue is received and whenever expenditure is paid. Now, it means that it's only when there is cash receipt and cash payment you record a financial transaction on your financial statement. That's the meaning of what that is saying. It means that anytime there is no cash evidence of cash receipt, or anytime there is no evidence of cash payment, that transaction will not be found in your financial statement. Now, talking about the last one is what is the break-up basis. Now, what do you understand by the break-up basis? The break-up basis is actually an accounting that is used for business that is no longer going to be in the business. It means that we are trying as much as possible to write off that business. That's what we are trying to do. We are trying to write off the business, and there's a way we do that. It means that when there is sales, wherever there is sales, it means that whenever there is a sales of, let's say there is a sale of asset, we normally record that sale of asset under an account called realizable account. It means that this is the total money I've been able to realize on this asset. So that is the way we prepare that. So it means that a company that is no longer ongoing concern they will use backup basis. Now let's look at an example of on how to differentials in when we use the actual basis and when we use cash basis. After this, I think I have to start. Okay, so now the first one we have is what we call a company prepares its financial statement to the 31st December each year. It sells goods for 100,000 to a customer on 25th December year 3, but does not receive a cash payment from the customer on the 1st February 20 year 4. What will be treatment under accrual and cash basis? So we're asking a question, what will be the treatment under the accrual and cash basis? Now, for me to answer that, I need to understand something, that under the accrual basis, I will need to record my transaction even though there's no flow of cash. Now, solution under accrual basis, the transaction will be recorded in year 3, even though no payment has been made. Even though no payment has been received. Now, it means that according to a company prepares its financial statement to the 31st December each year. It sells goods for 100,000 to a customer on 25 of it. So the points now, look at it now. which means our 12 months span between January to December of every year. So our financial report spans between what? January to December of every year according to this question. Now, in the third year, at the 25th of December, they make a sales of 100,000 on credit. So if that's on credit, it means that what? There's no evidence of cash. And the customer now pays for January 1st, February, year 4. So it means that at the end of year 3, how do you record these sales in what? Under the accrual basis. Now, under the accrual basis, you are going to record 100,000 as sales, even though you have not received the cash. That's why we said that what? That we normally include what? When revenue is earned. Why is the revenue earned here? Because the customer has received 100,000. So there's an obligation that you have fulfilled, and there's an obligation of your customer part to fulfill by what? By paying you for the goods that they receive. So that will be recorded in our financial statement in year 3. But under the cash basis, the transaction will not be recorded in year 3 because under year 3 we say that financial transactions are recorded when revenue is received, that's cash received, and when there's cash paid. When there's cash received and cash payment. But now, when do we receive cash? We receive cash in year 4. So it means that in year 3, there will be no accounting record for the sales of 100,000 in year 3. But the record will come up under year 5. So it means that the record will now show that the sales occur in year 4. It means that what? The sales occur in year 4. So that is the major difference between the accrual basis and the cash basis. Now let's look at question 2. Now this is question 2. A company starts in business on 1st August, year 1. So they start their business on August, year 1. It acquires an office for which it pays 1 year. 1 year rent in advance to 31st January or July, year 2. The cost of the annual rental is 200,000. The company prepares its financial statement for a financial period ending on 31st December each year. What will be the treatment under accrual and cash basis? Now, when you prepare the financial statement, they prepare the financial statement within a period of January to December. Guys, see that? That's where they prepare the financial statement. Now, they now ask us to what? The transaction. What is the meaning of this transaction? They start business in August 1. That's when they start business in year 1. And they acquire an office for which they pay 1 year rent to 31st of July, year 2. And you know, rent is what? Rent is always on a yearly basis. So rent is like a 12 months, right? On a yearly basis, so 12 months. Now, if that is the case, then it means that the amount I pay is for 12 months. How will I record this transaction? In my accrual basis, I'll look at, since I'm closing my financial statements as at 31st December, it means there will be a provision. That means from August 1st to December, year 1, how many months is that? You can count it as August, September, October, November, December. That is 5 months. That is 5 months. It means that the rent of 20,000 I paid, which is for 12 months, I will only enjoy 5 months in year 1. So I will do So what will I do? So just get your calculator. Get your calculator, website. So I'm putting my calculator as well. That's 5 divided by 12 times 200,000. That gives us 883,333. Now, this is what it means. It means that this one that we have here will be for year one. So on year one, you're able to recognize 83,333 in year one. And the order we brought on year two will be 11,000, 111,000, sorry, 116,667 naira will be your rent that you're going to utilize in year two. How do we get that? It's 116,667. The way we comply is we start from January. Let's count from January. January, February, March, April, May, June, July. That's 7 months for year two. 7 months for year two. So is that 7 months? Yes, count again. Yeah, that's 7 months. So that's 7 divided by 12 times 200,000. That was 116,667. So that's 67. So that is the way we work. That is the way we are going to put for year one. The total rate that we are going to recognize in our own financial statement is 83,333. While in year two, we are going to recognize the remainder, which is 116,667. But under the cash basis, we are going to recognize the totality of the 200,000. We're going to recognize everything under year one. I think that that rent is just for year one alone, because the year in which we pay that money for, it was the year that we pay the money. The year that we pay the money is in year one. And cash basis that whenever there is cash payment, whether it's for the year or not for the year, you record it in your financial statement. You record it in your financial statement. So that is the guide on that. That is the guide for that. Hello, my host. Hello, sir.
Hello.
Yes, sir. Please, I will like to restart my system. It's blinking.
Yes, your
So
voice is
give it
breaking,
some minute,
right?
please.
What
No,
do you
my
say, sir?
system is even blinking now. It's affecting my site. My system is blinking. The vision on my
Okay.
system is blinking, so I want to restart it. Just give me a few minutes. Yeah.
All right.
Okay.
Please. Okay, hello student. Please just give me a few minutes to restart. So I will lock that now.
Okay.
The material is loading. Please just give me 1 second or two. Okay, I believe we stop at the content of financial statements. So what are the content of financial statements? And I believe I've explained that also earlier. So welcome back to class. Now, content of financial statements is basically, it means that if you look at your financial statements, what are the things that you're going to see there? Okay. So on that note, we have the statement. Sorry, excuse me. Okay, so on that note, we have first one is a statement of financial position. Statement of financial position is the statement that comprises of your asset, your equity, right? Now, statement of financial is regarded to as gap. Is regarded to as gap. So when I talk about conceptual framework, is actually what is the framework that underpin the preparation of the financial statement using the concept, the gap, the rules, the regulations to prepare and present financial statement. So the conceptual framework is actually a guide. It's actually a guide. Is what is a guide that shows how things are being done, how you expect to prepare the financial statement. Is one that shows that okay, if you have financial statement, when to present it, and so on and so forth. So that's why we have it highlighted that a conceptual framework is a set of theoretical principles and concepts that underpin the preparation and presentation of financial statement. Now, this standard actually what, like I told you, it have the gap comprises of two things, which is the country law and the accounting standard. Now, what is the purpose? What is the purpose, or what do we derive from this framework? What is derived from framework? I believe you can tell us one or two. So the purpose of the framework, or what to derive or benefit that we derive from it, is number one, is assist in the development of further accounting standard and a view of what existing one. Now, if the accounting profession want to declare or want to issue another standard out to the public, they have to what? They have a basis to refer to. They have a basis to refer to. So the basis is the existing standard. You have to refer to that as well. And also, or if they want to review, they review the existing standard. So, and GAP is what? Is the theoretical what concept, rules, convention, rules, and everything that underpin and under the preparation and presentation of financial statement. So what we are saying is that it's actually give us a basis to develop a new one and to what to review the existing one. I think that also it provides a basis for reduction of number of alternative accounting treatment permitted by the international standard. It helps us to reduce the subjective treatment that is available to a lot of accountants. So which means that that each standard have their own way of treating it, and if it's not available, what are the other ways in which you can do it? That's hierarchy, looking at the hierarchy available for you for financial accounting. Another one we have is what assess national standard setters in developing national work standard. Now, this one talking about what is assist the nationals to actually prepare their own standard. For example, we have what we call IPSAS, International Public Sector Accounting Standard. And International Public Accounting Standard is as a result, is actually what it comes out from the existing standard. So it assists to what? To set a new standard. That's standard setter in developing nations standard. So that's what they're talking about there. So lastly, I want to talk about is the still on the same thing on the benefits. We have what provide information about the IAS approach to setting international standard. This gives us the breakdown or how the standards are issued, the step by step on how the standard are issued, so that everybody will know and everybody will try as much as possible to conform with the process. Now, what are the advantages of this conceptual framework? One of the advantages is that it avoids patchwork or firefighting approach. Now, what you don't understand is that it allows the accountant to prepare a quality report, not patch up. Not that my account did not balance, just add 1 year, add 2 year, add 3 year. No, it allows what it avoids patchwork. It removes the patchwork work that is available in the system. It removes it totally. And that one also is what less open to criticism of political and external pressure. Now, what this means is that when the outsider, the third party comes on board to review your financial statement, the level of the criticisms will be will be reduced. Why? Because there's a standard that you prepare that guide you to prepare that financial statement. So if they want to appraise you, they will appraise you based on the standard. They will not appraise you based on their own belief. That's why you said that is reduced or less open to criticism. Because what you are going to criticize me is on this the standard I've used. So you have to criticize me based on that. You cannot criticize me outside that standard. Another one also some standard may will concentrate on income statement, others on the statement of financial position. Now there are some standards that actually will address income statement, also known as statement of financial performance. That's the standard. There must substandard that actually that focus on it, while substandard focus on the statement of financial position. So it helps us to address each element in the statement. Then there's nothing that have advantage that does not have disadvantages. One of the disadvantages is financial statements are intended for a variety of users. So financial intended are intended for a variety of users. So single framework may not work. Because what I need in a financial statement is different from what another person needs. What that person need is different from what another person needs. So it means that if you are preparing general acceptable accounting standard, does not mean that what that actually can suit everybody that will want to make use of the account financial information. So it's actually what it's not a single format. It's not good for everybody, but widely good for many, but not for every. Now, another one too may need different standard for different purpose because each standard address different areas. So it means that you have to know almost all the standard for what for the different purpose in which you want to apply it to. For example, we have IAS 16 PPE. So it means that anyone to do anything about tangible assets should be on what on your PPE. We have another one also. We have IAS what I we have IAS what two. We talk about the inventories. It means that everything that you have to do must be on the IAS 2. Everything that you have to do on inventory must be in accordance with IAS 2. So you have different standard for different purpose. And sometimes it makes the word preparation of financial statement a little tedious. Also, another one is why we work called preparation and implementation standard is still difficult with a framework. Now, preparation and implementation of the standard is still not easy because interpretation of it matter a lot. Before you can actually go ahead and implement the standard, it's not just mere reading the standard. You have to read, understand, so that you can apply the standard in what in the financial statement. So it's not easy. It requires deep thinking and what review. Then we have the objective. What are the objectives of financial reporting? The objective of financial body is to provide information about the what the reporting entity. The reporting entity is talking about the concerned company that we are reporting on. So reporting entity that is useful to the existing and potential investors, lenders, and other creditors in making decisions about providing resources to the entity. So that's the objective that we have for financial statement. So they're talking about is what the objective is to make sure that information is available. Information is available for use for everybody. Now let's talk about the assumptions. So we have what we call what underlying assumptions according to IS1. We have some underlying assumptions because financial statement are prepared on some assumption. They are prepared on some assumption. So the framework identify one underlying assumption governing the preparation of financial statement, and the assumption is what we call that every standard that you are using to prepare an organization, that organization is what is a going concern organization. Going concern organization is that what the entity will still continue to operate with what with in the next foreseeable years without having liquidity or liquidation issue. It means that they don't have the issue to address or to meet their obligation as at when due. It means that what that they have the money and the funds to address their obligation as at when due. Then lastly, want to talk about is let's talk about the quality of God characteristics of the useful financial information. Now talking about what are the qualities of the data that you must find in your financial statement. What are the qualities? So this one is not talking about how quantitative, it's talking about the qualities now. So the qualities characteristics of this information can be divided into two. Can be divided into two. We have what we call the fundamental qualitative characteristics and we have the enhancement qualitative characteristics. These are the two, the qualitative characteristics that we have. Two. We have the fundamental and what and the enhancement. Now, or the enhanced. Now, these are the two that we have. Now, fundamental is divided into three. We have fundamental is now what? We have three types of it under it. We have firstly, we have relevant. Relevant means that what? Information relevant if it is capable of making a difference in decision making or made by the users. It means that the inclusion or the omission can actually affect the changes or can change the economic users, the decision that is made by by the user of the financial statement. If it can change it, it means that that figure is relevant. It must what? It must be shown on your financial statement. And that one we have is what we call what? Faithful representation. Faithful representation is talking about that what? That the data that you are including in your financial statement must be complete. It must be natural. It must be not neutral. They are for free or for any bias And also what? It must be free from errors. It must be complete. It must be free of bias and also free of error. So that's what we call what? Faithful representation. In addition to the two, so that's major two. Sorry, that's we have two under fundamental. We have the relevant and we have the faithful representation. Now, after that, we now have what we call the enhancing qualitative characteristics. So, and that enhancing qualitative characteristic is a backup to support the fundamental characteristic. If the fundamental is not there, there's no way the enhancing characteristic will work. So the fundamental must be in place first before the enhancing quantitative characteristic now come on board. Now, the first one is calling about what? About the comparability. Comparability means that information must be useful, that it can be compared with what? Or can compare with similar information about other entities or previous year. It means that if you are preparing a financial statement, the previous year and the current year should be together so that you can easily work, compare the two together. So you can easily compare the two together. Then another one that we have also is what we call the variability. Variability. Now it means that you should be able to verify the information that you have posted into your financial statement. It means that there must be a source document that have given you the go ahead to record that transaction in your financial statement, so that there will not be what we call dry posting. That you are posting something in your financial statement that does not have a legal backup for it. So if there's no legal backup for it, it should not be what? It should not be posted. It means you received the invoice that you are using must be able to be verified down it. So every figure you have in your financial statement must be supported by source document. The third one that we have is what we call the timeliness. Now the timeliness is talking about that the financial information are prepared within a particular period of time. For a particular period of time, it means that information that is timely for that period should be included. It should be what? It should be included. Older information that are not necessary should not be included. So time factor, if I'm preparing for 12 months, it's not what I don't need information. If I don't need information of 10 years ago, 5 years ago, or 3 years ago, it should not be what? It should not form part of my information that I'm going to put in my financial statement. That's why I said that information should be made available to users within time scale, which is likely to what? To influence their decision. This also means that when you are preparing your financial statement, it must be time-based. Time-based in saying that if the financial report is expected to be ready by January, make it ready by January. Because if you make it ready by March, it might not be as useful as if if it was made available in the month of January. So it means that what the timeliness is a part of things that enhance the quality characteristics of the financial statement. Then also the last one we have is what we call understandability. Understandability, ability to classify, ability to present, ability to what? To clarify the figures on your financial statement. When you are classifying it, classify in a neat way that everybody will be able to see it and understand it. For example, if I want to get my gross profit, I have my sales. My sales will be on another naira sign. I have my cost of sales. If I'm doing breakdown of cost of sales, it will be on another naira sign. Then the total will not be transferred. The reason is that I'm trying to clarify. I'm trying to what? To classify. And at the same time also, I'm trying to what? To pick items that have the same characteristics against each other. So that if we are going through my financial statement, you will understand if this is income or if this is expenses. So that is the what? That is the qualitative characteristics for the what? Or for the financial statement. So I would like to stop here today. I would like to stop here today. So if you have any question, please, this is the point that you can ask your question. If you want to ask your question, please use the chat button. Use the chat button to ask your question, and we'll be glad to answer you. And if there is no question, after 1 minute, we call it a day. Please use your chat button to ask a question if there's any. Okay, so in the absence of any question, so I would like to call it a day. So in the next class, we'll continue from where we stopped, and from there, we'll pick a question to solve. Okay, so this will be a good night from my own end to you, my host.
Yes, sir.
Yes, so sir, you can end the class, sir.